Good afternoon. Oh, yep, I'm there. Good afternoon. Welcome to another episode of SRT Live. So, is a recession unavoidable at this point? We're going to dig into that today. Thank you so much for joining me. I'm your host, Sean Richard, with the Sean Richard Mortgage Team here at Guaranteed Rate. Glad to have you on board. We've got a lot to unpack today. So strap in and let's dive in. As usual, we're going to dive into last week's numbers before we get into the week ahead. And then we'll finish up with some points to keep an eye on over the coming weeks and months in the economy and how it impacts the real estate and housing market. So if you're a real estate agent watching this, this is information that I want you to be able to take back to your clients so that way you can be more educated, you can build better credibility. If you're a homeowner or home buyer watching this, I want this information to be able to help guide your decisions. I want you to be able to help to make better educated decisions about your plans. But as always, any of you can reach out to me. My number's right here. You can also leave questions or comments in the chat below. And if you're watching this on YouTube, make sure to smash that subscribe button so that way you can get additional market information, business building ideas, all in the palm of your hand on your phone. So let's dive in. All right. So pretty quiet day today. Well, first off, yesterday markets were closed for the July 4th holiday. I hope each and every one of you had a wonderful and safe holiday weekend, and you get to spend some time with family, friends, loved ones. So the last week we got a pretty important reading. Last week was the third and final reading for Q1 GDP, and got stuff popping up all over the place. Last week was the third and final reading for Q1 GDP, and that came in at a negative 1.6. Now, important to know that the technical definition, not the more accepted current definition, but the technical definition of a recession is 2 consecutive quarters of negative GDP. And so we got the third and final reading of Q1 GDP last week came in at negative 1.6. So something we're going to watch. As always, we got on Thursday jobless claims or unemployment claims. And that's comprised of initial claims, which is individuals filing for unemployment for the first time, as well as continuing claims, individuals renewing their unemployment filings. And this is important to watch because this is also an economic strength indicator. So for initial claims, the previous reading, and these are week over week. So the previous reading was 233,000 new filings. And last week, we got 231,000 new filings. So staying in a very, very similar range. But recall that this is up from post-pandemic lows of the high 100s, 180, 190, 200, 210. So we've risen a little bit. We want to keep an eye on that. Continuing claims, last week's reading, the previous reading came in at 1.33 million. This week came in at 1.328 million. So again, very, very close to the similar numbers, but up from some of the lows that we've seen earlier this year. We also got the Fed's favorite measure of inflation, which is PCE, personal consumption expenditure. And this is broken into 2 different categories. You've got your headline reading, which is overall personal consumption expenditure, overall inflation. But then you also have your core reading, which strips out food and energy. And the reason that there's a core reading and the Fed does break that apart is because food and energy, the Fed looks at as not being able to have a whole lot of control. Food and energy have a much bigger impact by international markets, global economic conditions, such as the war in Ukraine is having a significant impact on both. The shutdown in Shanghai in China having a significant impact on energy. So food and energy not as controllable by the Fed, which is why they strip that out and have a core reading. Now the headline reading is typically what we as consumers feel when we're out spending money, buying services and goods. So the month over month increase to the month over month reading was a 0.7% increase. And year over year, we saw a I'm sorry, month over month was 0.6 with an expected 0.7 increase. So we came in a little bit better than expectations. Year over year, the market was expecting 6.5% inflation, and we saw 6.3%. Now, the PCE is an alternate inflationary report opposed to CPI, which is the consumer price index. The Fed tends to like PCE a little bit better, primarily because it does not take into consideration housing. And we all know that housing is one of the largest expenses that we have. So impact or increases to housing costs definitely gets felt in the wallets and the purses. So PCE is the Fed's favorite measure. So we came in a little bit better than expectations there. We want to watch this going forward with future readings to see how inflation is shifting after these most recent Fed funds interest rate increases. Lastly, last week, we also got the apartment list rental report. Now, this is for the month of June, and this measures increases to rents. So month over month, apartment list has rents up 1.3% and year over year 14.1%. Now, if you're a real estate agent, you know that buying is better than renting, but clients, home buyers may not always feel the same. And although there's a lot of different variables that go into making the decision to purchase a home instead of rent, one of the predominant factors for buying over renting is that you get to lock in that fixed cost. With that purchase, that principal and interest portion of that payment never moves. With that rent, it's going to go up year after year after year. And right now, we're seeing a pace of as much as 14.1% year over year. That $1,500 rent, although $1,500 is pretty hard to find right now, but that $1,500 rent a year later becomes $1,700. Quick anecdote: a personal friend of mine was living in an apartment in Dallas, paying about $1,300 a month. And this was last year. He had moved out of that a year ago into a different apartment community. This year, when his lease came up, he went to look back at that same apartment community he was renting last year to see if it made sense for him. And rent for the same apartment was $2,000, up $700 in a 12-month span. So rents increasing at extremely rapid paces. Although we're seeing home prices rise rapidly and we've seen an increased interest rates, rents are going up almost equally as fast, making housing a tough cookie for home buyer or for renters and home buyers alike. All right. So looking ahead to this week, we've got a pretty packed week. Tomorrow, we've got the Fed minutes. This is going to give us more insight into the Fed meeting. And sometimes with the Fed minutes, the additional clarity it gives us around the Fed's mentality with their monetary policy can be a market mover. So we want to be prepared for maybe a little bit more volatility tomorrow due to the Fed minutes. On Thursday, we get ADP payroll report. This is a precursor to the Board of Labor and Statistics National Jobs Report on Friday. Also on Thursday, we get our weekly jobless claims that I'll cover next week on Tuesday. And then Friday, again, the Board of Labor Statistics National Jobs Report. This is the payroll report. This is going to indicate how many jobs were added for the previous month. And then we also get the updated unemployment rate. Currently, the expectation is we're going to come in at 3.6%, which is where we've been sitting for a while now. So we'll keep an eye on that. One of the indicators of a recession is a bottoming of unemployment and starting to tick up. So we want to watch that. So I've mentioned a few different things that we need to keep an eye on as we move forward. So let's take a look at what that looks like going forward and what we really need to focus on in the coming weeks and months. Number one is going to be GDP. As you heard me mention, the technical definition of a recession is 2 consecutive quarters of negative GDP. And here recently, last week, the Atlanta Fed revised its Q2 second quarter GDP estimates to a negative 2.1% from a positive number. So they're expecting a significant decline in GDP for the second quarter. Now, the Q2 GDP readings will be July, August, and September. So we're not going to get that final Q2 GDP until September. And we may look back and say, oh, well, we were already in a recession. And some of you may already feel like that. And it's very possible that that's the case. But because of the expanded definition of a recession, we may not get an official call on a recession until later this year, whether it be September, even a little bit further. Second thing that we want to watch is unemployment rate and jobless claims. As I mentioned, a tick up in unemployment after a bottoming out is a very strong indicator that a recession is likely to come. And so the unemployment rate coming this Friday will be very important to watch. Whether we're going to stay at 3.6 or we start to see a move in the opposite direction is going to be a very telling sign. Jobless claims are up slightly from where they were earlier in the year, but they haven't had any significant stride upwards. But we've always seen the headlines in the media with various companies laying off workers heading into Q3 here. So we want to keep an eye on that over the coming weeks and months as well. And then the last thing to keep an eye on is the housing direction through the summer and fall. We've seen some really, really strong appreciation numbers despite economic slowdown. And the history of housing through recession has always been strong. Every recession dating back to 1960, with the exception of our 2008 crash, housing has either stayed stable or increased every single time. And so the strength of housing, even going into recession, is really important. We've seen appreciation reports with 20+% appreciation coming from our Case-Shiller report, as well as 18+ appreciation percentages coming from FHFA housing index, which is the federal housing finance industry. So continuing to see housing strength going through the summer. The housing appreciation reports are lagging. So the most recent report that we got was for the month of April. And so in July, we'll get May, and August, we'll get June. And so we want to watch those to see how that trend continues. Are we going to continue to see exceptionally high appreciation rates in the face of rising home prices and rising interest rates? Or are we going to see that start to slow down and showing that demand is diminishing a little bit? But remember, April, which is what the most recent appreciation reports were for, we had already started to see a healthy increase in interest rates. In April, rates had crested the 5% mark. And so it already has taken into consideration a significant portion of the interest rate increase environment that we've been working through over the course of the last 6 months. So it'll be very interesting to see where that ends up over the next couple of months. All right. And the last thing I wanted to touch on real quick today, and I'll have to maybe do a separate video just on this, is how to become recession proof. And I've got 2 quick bullet points for you. If you're a homeowner, home buyer, or if you're a real estate agent, you want to pass this information to your clients. None of this is earth shattering, but really, really important. Building savings going into recession, really, really important. With the Fed increasing the Fed funds rate, most banks are going to be increasing savings rates. Now, a high interest rate on your savings account is all fine and dandy, but if you're not putting any money in the account, then it doesn't matter what the interest rate is, then you're not going to be earning any money. It's never great to say, pay me interest and then I'll save. You always want to say, let me save and then you can pay me interest. So building a savings balance for rainy day funds, having 6 to 12 months of income in a savings account, so that way you can weather any recessionary storms, is an incredible place to start. The second is to periodically review spending and payments coming out of your bank account to cut unnecessary expenses. You may have streaming subscriptions that you never use. You may have other types of recurring monthly payments that you don't use their services on a regular basis. You want to constantly review those to keep your budget as lean as possible. And then in the event of a recession and some economic downfall for any individual household, reviewing those even deeper to see where you can make some bigger cuts of maybe some more luxury items that you don't necessarily need if you're trying to be as lean as possible. So building a 6 to 12 month savings reserve, as well as continually reviewing your finances to trim unneeded expenses are the two best things that you can do to help make yourself recession proof. All right. That's what I've got for you today. Again, I appreciate you joining me on this episode of the SRT Live with me, Sean Richard. Make sure to leave any questions or comments in the comments below. And again, if you're watching on YouTube, hit the subscribe button so that way you get all of the information on the real estate market and economic environment straight on your phone. Have an amazing rest of your day and your week. And I'll be back next week with another episode. Take care.